Blind already. Right, good evening. It's lovely to see you all here today. Some old colleagues from something nearly 40 years ago since I first started working with them. Some familiar faces who come to us on these occasions on a regular basis, and some new ones. So welcome to you all. I'm not going to bore you with loads and loads of slides. I've just got half a dozen. But for those of you who do attend regularly, you'll know that for the first couple of slides, I'll sort of give you some statistics and some numbers and some costs and casework that we've been dealing with. And I'll just repeat that on the first couple of slides. The first one I've shown here relates to the membership numbers. The numbers that are shown at the bottom of the screen. You'll see that there's been an increase in contributors and both pensioners and deferred members. And the increases in deferreds and pensioners are continuing to outstrip new contributors. That's nothing new. That's been happening for a number of years. As employers downsize their workforce, obviously that gives rise to increased pensioners and deferred members, and they don't set as many employees on to replace them. Those of you who were here last year will remember that I said we'd had a fall in contributors, and you'll see that that's been reversed this time. We've had an increase again in the contributors. I believe, or I would attribute that not to any massive influx of new workers that the employers are taking on. It's more likely to be late notifications of contributors that have taken time to filter through. So although we showed figures that looked like we were having a reduction last year, that hopefully and thankfully has been reversed. On to activity and performance. The number of tasks that we carry out are recorded through our automated system, so I'm able to give you accurate figures as to how many cases we've dealt with and what performance we've achieved on them. I haven't put the figures up for last year, but if I can just let you know what those are. Last year, for example, on contributors, we carried out 20,700 tasks. You'll see that we've carried out 27,000 tasks in the current year. That's an increase of around 30%. And I'm very pleased to say, and I'm very happy with the staff and always congratulate them, in maintaining performance. We performed at 98.4% of target last year, and as you can see, we're hitting 98.6%. So we're still up there, despite the significant increase in workload that we've carried. Similarly with pensioners, this year, or the past year, we've dealt with 33,500, 2,100 the year before, so we've done an awful lot of work associated with pensioners in terms of calculating pension benefits, in terms of answering queries that we've received from pensioners. That is a really big increase, and again, we've managed to maintain performance. We were 96.9% last year, and we've maintained and improved to 98.8%. So I'd like officially to congratulate all the staff in maintaining that performance, and I hope that I can take your congratulations back with me to the staff to that effect. In terms of unit costs, we continue to reduce our unit costs. I've listed the last 5 years, 6 years worth of unit costs. That's how much it costed administration per scheme member. And you'll see that the South Yorkshire figure is continually reducing. That's because of efficiency improvements and savings that we make, better ways of working. And we compare that to the local authority average. So that if we look at 2010, we're well under £2 per scheme member cheaper than the local authority average. Now, when you look at the number of scheme members we've got in the South Yorkshire Fund, about 125,000, that's contributors, pensioners and deferreds, a £2 per scheme member represents about £250,000 cheaper than the average local authority pension fund would be if we were at their level of cost. So again, costs are important to us. We do strive to maintain performance at a reduced cost. In fact, do more work with the resources that we've got, which in itself is an efficient movement. That's enough for the figures and the numbers. What I'm going to do on the next 4 slides is look at what's coming on the horizon. I'll look at the 2010 valuation just to give you an update of where we are with that process and what the initial results are looking like. The change in the index linking to the pensions in payment and the change and the pensions that are deferred, and that was announced by the government in the emergency budget. The Public Sector Pension Commission That's the Hutton report that the chairman referred to in his introduction. And a new innovation and advisory panel that the Pension Authority is putting in place to improve communication and consultation. On the 2010 valuation, it's a long process. Every 3 years the pension fund is valued by the fund actuary to assess where we are in terms of how much assets we are holding compared to the liabilities that we are carrying. We are expecting the position to have deteriorated since we last carried out the valuation in 2007, and that's only to be expected in the face of the financial situation we've undergone in the last 3 years. As you'll all know, it's been a difficult financial situation. There's been poor and volatile investment returns. We know that when the results come through, they will be worse than what they were 3 years ago. That doesn't mean to say that any pensioners' benefits are at risk. Pensioner benefits are guaranteed by statute, by the scheme. The fact that there'll be a shortfall in the pension scheme simply means that that has to be recovered, either through improved investment return or by employers putting more money into the scheme. But we know it's not going to look as good as it was last time. One of the reasons that the valuation will look different is that we've got changes in assumptions that the actuary uses to value the pension scheme. As I've said earlier, or inferred earlier on the previous slide, the government have changed the index linking from retail price index to consumer price index. Consumer price index, as you'll see when I come to look at that, is generally lower than retail price index. That's good for the pension fund. That means that the money that's needed to meet that reduced inflation is to the benefit of the fund. Life expectancy, again, has been mentioned. Life expectancy continues to improve. The statistics, we're always catching up. The actuaries are continually looking at studies, both in the insurance industry, and now they have a new study that gives us figures for people who are receiving occupational pensions, which are much more akin to what we're dealing with rather than general insurance policies. So life expectancy is increasing, pensions have to be paid longer, that's poor for the fund. It means we need more money in order to honour the pension promise that all pensioners have got in the scheme. And the membership movements, as I said at the very beginning, we are seeing more and more pensioners and deferred members compared to contributors. So in effect, we're paying more out and getting less in because the contributor base is not keeping pace with the growing pensioners and deferred members. So again, that puts a strain on the fund. It requires us to improve performance in order to have sufficient assets in the fund to be able to meet that promise. What it all boils down to is that the position will be worse. The recovery of the deficit that was put in place 3 years ago by the Pensions Authority was designed to recover the position over a 21-year period. We have gone through 3 years of that 21-year period, so we're 18 years left in that recovery period. Because the position will be worse, councillors face tough choices as to balancing the need to increase the contribution rate to ensure there's sufficient money there, and or to extend the recovery period to make it affordable for employers. There's no point at all in putting the pressure on the employers in the economic climate that we're in, especially with the cuts that's just been announced. The timetable for that is that the members of the Pension Authority will receive a presentation from the fund actuary in November, and that's when the tough choices will be made. That will then result in a consultation exercise where we'll go out to the other employers in the pension fund and to trade unions and people representing scheme members, get their feedback as to the proposals that are intended to be put in place, and that will then formalise the valuation, resulting in the actuary completing his report and specifying the new contribution rates to be applied to the employing bodies. So that's where we are with the valuation. I can't give you any numbers because we don't have any numbers. All I'm suggesting is we know it will be a deterioration from 3 years ago. The next one, we are looking at the change in the inflation protection. Traditionally, the pensions have been protected against inflation by applying retail price index. In other words, what is the rate of increase in the general retail prices? The government announced in the emergency budget that they were changing the index to consumer price index. Generally, the difference between the two is that consumer price index excludes housing costs. So mortgage payments and council tax payments are excluded from the normal index. As a result, consumer price index is traditionally lower than retail price index by about 0.5 to 0.7% on a historical basis. Last year you didn't get any increase in your pension because inflation was negative. So your pension was frozen, didn't go down because inflation was negative, but it didn't get any increase. This year there will be an increase. The rate announced for consumer price index is 3.1%. That is applied in the same way as the old retail price index was applied. So come the first Monday after the 5th of April, which I think, I looked before I came out, is the 11th of April, the pensions will be index linked by the 3.1%. So details will be supplied at that time in our newsletters, and a payslip will be issued so that you can see what your old pension was and what the new pension is. The basic state pension, which is not our realm, by the way, the government is applying a three-test protection to the increase in the basic state pension, and they announced that that would increase by the higher of the rate in increase in earnings, consumer price index, or 2.5%. Well, we know that consumer price index is already above 2.5%, so we can ignore 2.5%. We suspect that the rise in wages isn't a great deal, given the financial climate. So one would expect the same 3.1% that we're applying to our pension will also be applied to the state pension.